Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are strapping in for a deep dive that I think really summarizes the current economic moment. We're going to tackle two highly relevant and, let's be honest, pretty complex topics, but we're going to structure it for those of you looking to really get a quick grasp on the core financial drivers that are shaping global markets right now.
Yeah, the goal is to get that depth of understanding, but, without the information overload.
Exactly.
Yeah.
So first up, we're heading straight into the high-stakes drama happening in the Japanese auto industry.
And it is a drama.
It really is. It's such a fascinating economic case study. We've seen this dramatic, almost catastrophic crisis in the first half of the year, and then it's followed by an equally dramatic financial reversal.
A complete flip.
A complete flip. And this whole roller coaster is because of these two conflicting pressures. You've got U.S. trade tariffs on one side, a massive fixed cost, and then you have the extreme volatility and weakness of the Japanese yen.
It's the ultimate tug of war between government policy and pure currency forces.
It really is. And then for the second half of our deep dive.
And second, we're going to pivot. We'll go from those big external macro shocks to something more internal, an investment philosophy. We're going to analyze that legendary principle from Oak Tree Capital.
If you avoid losses, profits will follow.
That's the one. And that idea is, I think, more critical than ever in today's, highly volatile, almost euphoric AI-driven market.
Feels like it.
It's all about adopting a stable defensive mindset. It's about mastering risk management and, crucially, learning to spot the losers that could absolutely tank your portfolio instead of just obsessively chasing the next piece of market hype.
So our mission today is pretty clear.
Yeah, it is. We want to distill the facts. We're talking massive financial hits, currency dynamics, these huge corporate pivots, and all the signs of market excess, but using simple concepts and, practical examples.
We want you to walk away understanding not just what is happening in these complex areas, but really why it matters for your investment decisions. Actionable knowledge.
Exactly.
Okay, let's unpack this. We'll start with the Japanese auto shock, which truly was a perfect storm, hitting the sector so hard this past spring and summer.
A perfect storm is the right way to put it.
So the data for the first half of the fiscal year, we're talking April through September of 2025, it just paints this picture of absolute financial catastrophe for the whole Japanese auto sector.
Yeah, and this wasn't a minor blip. This wasn't just a bad quarter.
No, we're talking about the first simultaneous profit decline for all 7 major Japanese auto companies in 5 years.
All 7. That kind of unified suffering, across an entire sector, that tells you it's a systemic external problem. It's not just one company making a few bad decisions.
Absolutely. And the severity, it went beyond just, profits going down. Several major players actually fell into deficit. They were reporting losses.
That's right. The recent analysis shows that companies like Nissan, Mazda, and Mitsubishi, these are globally recognized brands, all of them reported a loss for that half-year period.
That's just stunning. It shows that these macroeconomic headwinds were strong enough to just completely dismantle the profitability of these manufacturing giants that we usually think of as so resilient. So when you analyze the source material, it clearly points to where the pain came from. And it wasn't one thing, it was this devastating dual punch.
A dual punch. 2 enormous forces hitting them at exactly the same time, which just maximized the damage.
Let's break those 2 down. What was punch number 1?
The punch number 1 was the big one, the core financial shock. It was the introduction and the maintenance of U.S. high tariffs.
Great.
And the analysis available, the numbers are just staggering. These tariffs hit the 7 major Japanese companies for a combined loss of 1.5 trillion yen.
$1.5 trillion yen.
It's a direct tax on their whole way of doing business. Let's make it simple. Imagine you're an exporter. You make a car in Japan, or even just the parts, and you ship it to the U.S.
Okay.
That tariff, which is currently sitting at 15%, is an immediate high percentage tax you have to pay right at the border.
So that cost either gets passed on to the American consumer, making the car way more expensive.
Right, which hurts your sales volume. Or the company has to eat that cost themselves to keep the price competitive.
And that just destroys their profit margin.
It destroys them. It's a massive, politically driven financial punishment for importing into the U.S. Simple as that.
Okay, so that's the first gut punch. 1.5 trillion yen. What was punch number 2?
Punch number 2 was the currency problem. But it was working in the opposite direction of what we're seeing today. We're talking about yen appreciation. They call it endaka.
And that hit them for another 700 billion yen. So if you add it all up, What was that, 2.2 trillion yen? Wiped out in just 6 months.
Over 2 trillion, yeah. It's a mind-boggling number.
Okay, now, currency mechanics can be a little tricky, especially for new investors. So let's just walk through what endaka, or a strong yen, actually means for a company.
Let's do it. So imagine you're Toyota. You sell a car here in the US for, say, $30,000.
Okay.
When the yen is strong and it appreciates, that exchange rate is really unfavorable for you as an exporter. That $30,000 you earned in America, it translates back into fewer yen than it did before.
So you bring the money home to Japan, but it buys less. It pays fewer employee salaries, covers fewer of your costs back home.
Exactly. A strong yen just fundamentally crushes the value of every single dollar you earn overseas. And that 700 billion yen hit just shows you how devastating an unfavorable currency move can be.
What's really illuminating in all this data is how it highlights what the materials call the curse of U.S. dependence. This crisis didn't hit everyone equally.
Not at all. It was completely disproportionate. It acted like an immediate stress test on how geographically diversified these companies were.
So who got hit the hardest?
Take Subaru, for example. The data reveals that an astonishing 80% of its revenue comes from the U.S. market. 80%.
Wow.
And Mazda is also very heavily reliant on the U.S. at around 30%. So these companies with these highly concentrated revenue streams, they just got hammered.
Because both of the pain points, the tariffs and the bad currency exchange rate, were hitting their main market.
Precisely. They had no other big profit centers in other parts of the world to compensate for the damage. It just magnified everything.
And to really show the scale of this shock, you just have to look at Toyota.
Yeah.
Even the global titan, arguably the best managed car company in the world, they couldn't escape this.
No, they couldn't. The analysis confirms that Toyota recorded its first half-year operating loss in the North American market since the 2008 financial crisis.
That one data point just tells you everything. This wasn't just a cyclical downturn. This was a severe systemic shock that went right for the core profitability of the entire Japanese auto sector.
But as we know, economic environments, they're rarely static. And this is where the whole story just pivots dramatically, right around October 2025.
The plot twist.
The plot twist, yeah. The core finding from a lot of internal corporate analysis is this acceptance of tariffs as the new normal.
So they just decided, okay, this isn't going away.
Exactly. It's a huge shift in mindset. It means that 15% tariff burden, which was this massive shock in the first half of the year, is now just treated as a fixed, permanent cost of doing business in America.
And they were hoping it might get reduced, right? After the U.S.-China trade truce at APEC.
There were some fleeting hopes, yeah. But the sources confirm the U.S.-Japan auto tariffs were maintained, so that financial pain has just been baked into their operational model. It's the new baseline for profitability on any U.S.-bound exports.
Okay, here's where it gets really interesting. So once that painful fixed tariffs became the constant in the equation,
Right.
the other massive variable flipped and it changed everything.
Yeah.
I'm talking about the extreme yen depreciation. Adyasu.
This is the plot twist. It's a complete 180 from the first half of the year.
In just a matter of weeks, the yen just plummeted to a level we haven't seen in 35 years. It broke that critical 155 yen per dollar threshold.
This kind of currency collapse, it goes against decades of previous stability. It's a colossal financial shift in a very, very short period of time.
So what caused it? Why did the yen suddenly get so weak?
Well, to understand the mechanism, you really have to look at the global interest rate difference. The drop was driven by two powerful factors working together.
Okay.
First, you've got persistent, really robust U.S. inflation. That forces our Federal Reserve to keep interest rates high. And that makes the U.S. dollar an extremely attractive asset for global investors who are looking for a good yield.
So money just flows into the dollar, making it stronger.
Exactly. And then second, you have the yen being weakened by expectations around Japan's new political leadership, especially Prime Minister Takaichi.
What's the thinking there?
The market is anticipating her administration is going to pursue really accommodative or easy fiscal policies. So more government spending, more stimulus, all designed to finally pull Japan out of decades of low growth.
And easy money policies almost always devalue a currency.
Universally. The supply of yen goes up relative to global demand, so its value goes down. The combination of a strong dollar and a weak yen that created this dramatic 35-year low.
And the practical effect for those Japanese car companies was, what? Instant relief.
Instant, massive, and incredibly positive. Suddenly, the entire financial math just flipped back in their favor.
Let's go back to our $30,000 car example.
Perfect. That $30,000 car sale. Now, it translates into significantly more yen when the company brings those dollars back to Japan.
Right. So if the yen drops from, say, 120 to 155 per dollar, that means your $100 million in U.S. sales suddenly gives you tens of millions more yen to pay your local costs.
It's a huge boon for them. Yen weakness gives them this massive competitive edge because every dollar they earn abroad just stretches so much further back home.
And this isn't just theory, right? We have data on this.
We have hard data confirming this slingshot effect. The Nomura Securities Report, published mid-November, forecasted that this extreme yen weakness is expected to largely offset those huge 2.2 trillion yen losses from the first half.
So the gains in the fourth quarter could wipe out the losses from the previous 2 quarters.
That's the forecast. Think about that. A currency movement alone, something totally outside of their control, is projected to wipe out the losses caused by high tariffs and a bad exchange rate from the previous 6 months.
Wait a second. So are you saying that a volatile currency movement is now seen as more reliable for their profits than their own corporate strategy? I mean, isn't that a massive new risk?
It absolutely is a massive new risk. You've hit on the key point. It just underscores the perilous, macro-driven world they're operating in.
They're basically trading one fixed pay in the tariff for a huge but incredibly volatile injection of profit from the weak yen.
That's a perfect way to put it. And this reliance on Inyasu immediately brings up the threat of government intervention.
Because if the yen gets too weak, say it breaks 160, the Japanese government has a very strong incentive to step in.
A very strong political and economic incentive. They need to prevent destabilizing import inflation for their own citizens. And if they intervene, the yen strengthens, and that entire profit buffer that the car companies are enjoying, it could disappear literally overnight.
So their current success is basically a high-stakes gamble on the currency market.
It is. Even if the short-term market reaction is positive, the underlying situation is anything but stable.
So that initial crisis, that dual punch, it seems like it forced these Japanese auto companies to look at the U.S. market differently, not as this permanent, reliable ATM, but as a source of political and currency risk that needs to be managed carefully.
It was a wake-up call. The source material shows a fundamental shift in how they view their global operations, all in response to this tariff new normal. They are fundamentally de-risking.
And how are they doing that? What's strategy number one?
The first core change is, well, it's mandated by that fixed tariff cost. It's forcing a shift in geography. Strategy one is what we can call de-America, a measured shift away from their high dependency on the U.S. market.
They're trying not to have all their eggs in one basket.
Precisely. To mitigate that ongoing tariff risk, these firms are actively accelerating their efforts to expand manufacturing and sales in non-U.S. markets. It's a crucial long-term portfolio shift to diversify that risk.
And where are they looking?
We're seeing a lot more focus on rapidly growing, less politicized markets. Think the ASEAN bloc in Southeast Asia, India, and even targeted expansions in Europe.
India seems like a huge opportunity.
Immense long-term growth potential, and it's relatively insulated from these U.S.-led trade policies. This strategy is all about ensuring corporate longevity by reducing that concentration risk in a single, highly politicized, and right now, very expensive U.S. market.
Okay, so that's strategy one, go global. What's strategy two?
Strategy two is an aggressive, all-in bet on a specific technology. Hybrid electric vehicles, or HEVs.
Not pure electric, hybrids.
Hybrids. And this pivot is directly informed by which companies were able to stay stable during that initial crisis.
Right. We noted earlier that while Toyota suffered a loss in North America, they were still the strongest of the 7 overall. And the reason was their HEV sales.
Exactly. Their highly profitable HEV sales actually increased by a robust 9%, even in the middle of all that turmoil. The hybrids proved to be their financial bedrock.
So this is a critical insight into what's actually happening in the global car market right now.
It is. The whole industry is dealing with this notable slowdown in pure electric vehicle BEV growth. Consumers are still worried about range anxiety, the high upfront costs, and, just not enough charging infrastructure. And on top of that, BEV production has its own set of complex policies, subsidies, and increasingly its own tariffs, especially when it comes to where the batteries are sourced from.
So by doubling down on hybrids, companies like Toyota and Honda are just taking a more pragmatic path?
A pragmatic and profitable path that aligns with where consumers are today. The analysis actually says that HEV is now seen as the only viable alternative.
The only viable alternative. That's a strong statement.
It is, because it sidesteps both the expensive BEV growth slowdown and those high tariff risks associated with building out brand new BEV supply chains in these volatile trade environments.
So HEV uses their existing mature infrastructure while still giving them better emissions, and it meets consumer demand, and it's more profitable.
That's it. It's the safe, profitable bet in an uncertain world.
Okay, we've broken down the forces, the corporate response. Now let's synthesize this. What does all this mean for you, the investor, who's trying to navigate this chaos?
Insight 1 really focuses on the core analytical challenge here. You have to continuously compare the size of these conflicting forces, the tariffs and the yen.
It's not about picking a side. It's about seeing which one is stronger at any given moment.
Exactly. Investment success here is about accurately comparing the size and volatility of these opposing pressures in real time. It's the ultimate economic tug-of-war.
So you have the downward pressure from the tariffs. That's a 15% fixed cost, a predictable drag.
A predictable drag. And then you have the upward pressure from the weak yen, which provides this massive but variable profit advantage.
And what determines the outcome isn't just the exchange rate itself, right? There's more to it.
There is. Corporate hedging is a huge factor. Large companies actively hedge. They lock in their expected currency rates months in advance to provide stability. So if a company hedged poorly before the yen collapsed, they won't even realize the full immediate benefit of this enyasu.
So their own financial strategy could be holding them back.
It could be shackling them, yeah.
Yeah.
It adds this whole other layer of internal complexity to this big external fight.
So the key is understanding what the market is betting on right now.
Right. And as of November, the market is aggressively betting that the upward boost from the extreme yen weakness is going to overwhelm the downward drag from the tariffs. It's largely based on analyst forecasts using the current exchange rates.
But that requires, as you said, extreme vigilance.
Yeah.
This is so volatile.
Incredibly volatile and politically sensitive. If the yen were to suddenly strengthen, let's say the Bank of Japan intervenes after it breaks 160, that huge upward profit pressure just vanishes instantly.
And then you're left with only the fixed 15% tariff burden, which could trigger a really rapid, really severe stock price decline.
Which makes these Japanese auto stocks look a lot like leveraged bets on continued currency weakness right now.
Okay, so that's insight 1, the tug-of-war. What's insight 2?
Insight 2 is that diversification is destiny. The detailed financial results from that disastrous first half of the year give us empirical proof. U.S. dependency is the key differentiator between stability and going into deficit.
You just have to look at Subaru and Mazda again.
Exactly. With their high reliance on the American market, they face this debilitating tariff shackle. Even with a weak yen, their core market is structurally burdened by that high fixed cost. It just limits the overall financial boost they can get.
They can't fully capitalize on the currency advantage if their sales or margins are constantly being eroded by that tariff wall.
They can't. But then you look at Toyota with its diversified global portfolio, Asia, Europe, Latin America, its strength is its ability to compensate.
So when their North American segment takes a hit from tariffs like it did earlier the year, stable profits from other regions can offset that loss.
It minimizes the concentration risk that's just so dangerous in today's politically volatile trade environment.
Okay. And the final insight.
And finally, insight 3. The true winner is hybrid. This is all about technology and policy risk management. The data from 2025 is clear. The global market winner, when you measure by profitability and stable demand, is the HEV, not the BEV.
It offers that trifecta you mentioned.
A powerful trifecta. First, high profitability from mature supply chains. Second, it meets current, real-world consumer demand, avoiding all the expensive infrastructure and consumer anxiety of the BEV slowdown.
And third, maybe the most important for investors, it carries lower policy and regulatory risk.
Much lower. The pure EV sector is constantly subject to new politically motivated regulations, volatile subsidies, geopolitical supply chain issues. Hybrids are just more stable. So if you're looking for a long-term play, you focus on the companies leading in hybrid tech. Toyota, Honda. They're strategically positioned for profitable stability that goes way beyond these short-term currency shocks.
So what does this all mean? It means understanding that external forces, things like trade policy and central bank rates, are just as important, maybe even more important, than internal company management in today's global economy. We've seen how quickly a market can pivot from crisis to opportunity based on these massive levers. So now let's take that concept of avoiding major external losses and apply it to your own investment mindset, especially in this volatile AI market.
A perfect transition.
We'll transition now to our second major theme managing risk, avoiding those major drawdowns in the current, let's face it, euphoric AI-driven market, using a legendary investment principle as our guide.
I'm ready.
All right, for our second segment, we're turning to a guiding light of defensive investing. Howard Marks and Oaktree Capital's famous motto, if you avoid losses, profits will follow.
It's a classic for a reason.
It is, and it feels so crucial today because the market is just dominated by hype. It's driven by momentum, and that often leads investors to just forget the fundamentals of risk.
And the core concept of the motto is, it's elegantly simple, but it's so sound. Investment success is not about accurately picking the absolute best winner, that one stock that goes 10x. It's about successfully and consistently avoiding the worst losers.
The ones that go to zero.
The ones that suffer catastrophic drawdowns or go bankrupt. I mean, think about the harsh math of a loss.
Oh, it's brutal.
It is.
Yeah.
If you invest $100 and it drops by 50% to $50, you need 100% gain from there just to get back to even. If you invest in 3 stocks and 2 of them go up 50%, but that third one, the loser, goes to zero, that 1 0 wipes out a massive amount of your combined gain. Avoiding that one catastrophe is mathematically more important for your long-term return than the gains from the others.
And recent analysis really confirms that the current market, as of late 2025, is just. It's characterized by this intense excitement over AI winners.
Right, and that euphoria is precisely what's masking all these potential losers lurking just beneath the surface.
So we need to adopt a deep defensive posture. Use the oak tree principle as a shield against the market's excesses.
A shield is a good way to think about it. And based on recent market warnings and some pretty big corporate failures, we can outline 3 primary areas where these losers, the assets you have to avoid to preserve your capital, are hiding in plain sight right now.
Okay, let's get into it. Loser category 1, private credit and BDCs. I think
Yeah.
Jamie Dimon famously called them cockroaches earlier this year.
He did. He warned that the good times were hiding some deep structural problems. And the warnings here are really specific.
So break it down for us. What is private credit?
Private credit is basically direct lending to small or medium-sized businesses, often the ones that are too risky for a traditional bank. And BDCs, or business development companies, are regulated firms that invest in these private companies, and they often pass that high yield directly on to investors.
Oh, what's the danger?
The danger came to the surface with the very public failure of First Brands, a private equity-backed firm that just collapsed.
And what caused that?
The underlying risk is high leverage combined with rising interest rates. The sources explain that this pervasive thirst for yield over the last decade caused investors and lenders to just drop their basic due diligence standards.
So now that interest rates are higher, these leveraged companies can't pay their debts.
They can't service their debt. These high-yield investments are essentially defaulting bonds that are masquerading as safe income. Under the oak tree principle, these are the losers that you have to rigorously exclude.
And they're complicated, right? You see terms like structured risk transfers or SRTs.
Very complicated. An SRT is a complex financial derivative that packages up these underlying credit risks. And my rule is simple. If you can't define what an SRT is, you definitely shouldn't own an investment that's exposed to one.
That's a good rule. Okay, loser category 2. This one hits right at the core of all the excitement. Unprofitable AI hype companies.
The market's been running on narrative, but fundamentals are starting to bite back.
We're seeing this really critical shift in the market narrative, right? The focus is moving away from just revenue growth potential and moving towards profitability verification.
Yes. The new question is, can this company actually make real money now? The hype stocks that just had a great story, they're now being put to the test of quarterly cash flow.
And we've seen some cracks. The recent Oracle shock, for example.
Right, where the software giant saw its stock get hit hard despite these strong AI projections. It highlighted just how fragile some of these major infrastructure contracts can be.
And then you have the documented insolvency risks with some of these high-flying AI infrastructure providers, like CoreWeave.
That's a crucial case study. The vulnerability is in their business model. They rely so heavily on high-cost capital expenditure, buying all those expensive GPUs, and they're often overly dependent on just a few major cloud provider contracts.
So if just one of those contracts gets delayed or renegotiated,
their entire fragile revenue structure collapses. They don't have diversification, and they have these enormous fixed costs.
so the warning is clear.
Avoid companies with great AI stories, but no demonstrated ability to turn that story into reliable profits and cash flow. We have to focus on metrics like free cash flow and sustainable unit economics, not just top-line revenue growth projections. These cash-spending firms are the potential losers of the next market correction.
Because once the narrative breaks, there's no financial foundation there to support the stock price.
Nothing.
Okay, and loser category 3 points to a classic late-stage bubble indicator, the last buyer.
And that's usually mass retail involvement in overly complex, exotic products.
The concerning sign cited in the analysis is the plan by Robinhood to launch non-public AI investment funds, and they're aimed specifically at individual retail investors.
Now, regardless of the quality of that specific fund, the timing and the target audience, that signals a very serious market phase.
It's a classic bubble top signal, isn't it?
It is. The widespread, democratized retail involvement in high-risk, often opaque private assets. Institutional money gets into these deals early and cheap. Then, when the market is nearing overheating, the most aggressive platforms start offering access to the riskiest, late-stage, and least liquid investments like non-public funds to the masses.
And historically, that suggests the rally is near its peak.
Or at least entering its most dangerous phase. The oak tree principle explicitly advises against jumping into dangerous, complex, illiquid products at the overheated tail end of a massive rally. The fees are high, the liquidity is low, and the due diligence is impossible for the average person.
You're just setting yourself up to be the last buyer.
And therefore the guaranteed loser when the bubble eventually bursts.
So if the goal is to avoid these losers and preserve our capital, we need a complete shift in our psychological focus. Insight 1 is to actively shift your mindset from FOMO to FOLO.
Exactly.
The market today is just overwhelmingly dominated by FOMO. Fear of missing out. That panic that everyone else is getting rich off the AI rally while you're standing on the sidelines.
And it causes people to abandon their risk tolerance. They chase things they shouldn't.
Right.
But the immediate priority, if you're following the oak tree playbook, should be FOLO. Fear of losing capital.
Fear of losing capital.
When the bubble signs are as clear as they are now with these unprofitable hype stocks and risky private credit, prioritizing the preservation of your principal is the most important goal. If you don't lose money, you are already ahead of the vast majority of leveraged or panicked investors when the market eventually turns.
So insight 2 is that defense is the best offense. The analysis is very specific here. The long-term success of defensive strategies is determined not by the one incredible stock you bought,
but by what you excluded from your portfolio.
That defensive posture, it fundamentally changes the questions you ask as an investor.
It does. Instead of asking which AI stock is going to 10x next year, you should be asking, is there a second First Brands or an unprofitable hype stock currently hiding in my portfolio that has excessive leverage or default risk?
So what's the actionable strategy?
It's portfolio pruning. You have to proactively go through and eliminate assets with excessive leverage. You have to get rid of investments that lack transparency, like those complex private credit funds or anything with structured risk transfers, and any holding with a high inherent default risk.
And tactically?
Tactically, it means setting strict, non-negotiable stop-loss orders on your high volatility names. It means prioritizing screening for free cash flow generation over just top-line revenue growth. Defense in this market means getting rid of the potential losers before they get rid of your capital.
And finally, Insight 3 champions the value of simplicity and understanding.
Which is so underrated.
It is. The market is full of confusing, complex risks right now. Opaque private equity, complicated AI financial models, derivatives. Complexity just serves to mask risk, doesn't it?
It does. If you can't understand the asset, you can't manage its risk. It's that simple.
The core of the oak tree principle is staying within your circle of competence.
It is. If you cannot clearly understand and analyze how an asset makes money, what its debt burden is, what its supply chain risks are, then you're not investing. You're just relying on faith, not analysis.
So the prudent path forward is to focus relentlessly on quality companies.
Relentlessly. And the analysis defines those as companies with robust, healthy financials, reliable cash flow generation, and simple, comprehensible business models.
Yeah, they might be perceived as boring compared to the next big AI unicorn.
But concentrating on quality, high return on invested capital, stable free cash flow, low debt, that is the surest way to avoid major catastrophic losses. It ensures you can manage risk because you fundamentally understand what you own and how it operates.
Regardless of whether the yen is strengthening or tariffs are rising, investing?
Exactly. This consistent defensive approach, avoiding the obvious high-risk traps and focusing on fundamental quality, is the sole path to surviving a chaotic, euphoric market and emerging as a long-term winner with your capital preserved.
We've covered an immense amount of ground today.
We really have. We mapped those external economic forces that are just dramatically affecting global auto manufacturing, that fixed burden of U.S. tariffs being temporarily overwhelmed by the volatile advantage of extreme yen weakness.
And then we shifted gears to that internal mindset that's required to survive this market, emphasizing follow over FOMO and the absolute necessity of just eliminating potential losers from your investments.
It's a powerful lesson in global interconnectedness, corporate strategy, and defensive investing.
It is. Here is a provocative final thought for you to mull over. Reflect on the strategic pivot of the Japanese auto companies. If persistent, politically driven global economic risks, things like U.S. trade policy, are strong enough to force major global manufacturers to completely rethink their dependence on the massive U.S. market and pivot away from pure BEV towards HEV, what does this tell you about the true stability and the long-term direction of the global economy and technology adoption? It suggests that in the face of macro uncertainty, stability, mature technology, and high profitability are winning out over those aggressive, unproven growth narratives. Don't forget to subscribe and hit that like button.